All right, chapter 1, 10 principles of economics. First of all, we're going to start off with the basic definition of what is economics. Economics is the study of choices, how you and I make choices, businesses, or how even a society makes choices because all resources are scarce. Because all resources are scarce, we cannot fulfill everybody's maximum needs and wants because everything is limited in comparison to how many people want that thing. There are two basic subdivisions of economics. The first one is microeconomics, and this looks at how households or business firms make decisions with their scarce resources. So, this is about things like profits and costs. And then macroeconomics looks at large economy wide phenomenon like the entire US economy. And it looks at things like price inflation, unemployment, GDP. The first principle of economics is that people face trade offs. Every time you make a decision, you have to choose one thing over another, and that's how we get a trade off. So let's say you have a really big exam tomorrow. So how do you spend your time tonight? Now, some of you would say you'd study for a test, but we know that not all students study for every single test they have. So there's lots of other things you could be doing with your time, and sometimes you might opt to do those things and not study. If you have two big exams on the same day, now you've got a more difficult decision. Do you study for one of them, both of them, or do neither? And if so, how do you split your time studying for the two exams? Now, some people would make this decision by looking at their grade in a class, by predicting whether they think one test is going to be harder than the other, by looking at the point value of the test compared to their particular grade or how their grade on this test could go up, based on how well you know, like the material and want to actually study for it. So there's lots of different choices you can make as to why you do one thing over another. Families also have to make these choices. A family's disposable income is the money they have left over after they've paid their major bills. So, I want you to name one way a family might spend their disposable income. So, some of you might have said go on vacation or save and invest that money. Disposable income means all the bills are paid, so the rent has been paid, the electricity is on, food is on, gas is in the car. And lots of people also, in addition to those things, will upgrade the things they have. They buy a nicer house in a nicer neighborhood, or they buy a second car, or they save up money for something like a private school education for their kids. So, name something that a company can do with their profit. Profit is defined as revenue minus costs. So remember again, a profit assumes that the costs have already been paid. Your workers have been paid. The ingredients it took to make that product have already been purchased. They've already done advertising and marketing for that product. So some firms decide to give that money to their shareholders if the company is owned by stockholders. They call these dividends. Some companies decide to share it with their executives. So people in management, upper management, executive level, or CEOs often have in their pay structure a bonus based upon the company's profitability. So they basically take those profits, let's say it's, $1 million, and then they, devise a plan on how to give that out in bonuses to executives. Governments also have to make decisions with scarce resources. Obviously, tax revenue is scarce, so they have to figure out what's the best way to spend our tax dollars. I've put two examples here. Let's say that these both cost literally the same amount. The government could spend that money fixing our roads, getting rid of potholes, smoothing them out so that people aren't, popping their tires when they drive. Or they could give a subsidy to a business. Subsidy is free money that the government gives to a business. This helps them to reduce their costs or sell that product cheaper. It's sort of like welfare, but for businesses as opposed to a family. Now, there are both positives and negatives to both of these examples. It's not that fixing roads is always better than businesses or subsidizing businesses is always better. They both have both positive and negative side effects. So you always have to weigh those things before you figure out which one would be best or best suited to the society at the time. Remember, all of society's resources are scarce, so governments often have this trade off between making an efficiency decision or an equity decision. Efficiency means you're going to spend your money in order to get the biggest return out of your scarce resources. And an equitable decision means you're going to use that resources and spread it fairly or equitably amongst all the people in the society. It's not that a government always makes efficient decisions or equitable decisions. They actually make a little bit of both. From our previous example of fixing the roads or subsidizing businesses, which one would be efficiency and which one would be equity? And hopefully you figured this out, that fixing the roads would be an equitable decision and subsidizing businesses would be efficient. If we give a subsidy to a business and they can produce that product at a lower price, sell a lot of goods, then as their profits go up, they have to pay taxes on those profits. So that would give a return to the government. But roads are equitable. We do not only let taxpayers drive on our roads. So everybody is allowed to use things like roads and sidewalks and parks. We don't let just people who pay taxes, low income people, homeless people can use the roads too. And so doing something like that would also help everybody, including businesses who also use the roads. The ultimate idea behind economics is, do you make decisions that taste good or do you make decisions that are good for you? Ultimately, if you are trying to make the very best decisions for yourself, you would make the decisions that are good for you in the long run. Now, sometimes a taste good decision tastes really good right now, but it's really bad for you in the long run. And sometimes things that are really good for you in the long run are really hard to do in the short run. So this is a long run, short run trade off here. But ideally, if you're trying to maximize your benefits, you would always be making decisions that are good for you.